Imagine for a moment that you are looking at your banking app right now. You see a number. Perhaps it is $5,000, $10,000, or maybe even more. In your mind, that money is safe. It is tucked away in a digital vault waiting for you to use it whenever you need it. You feel a sense of security because you believe you possess that value. But what if I told you that the number on your screen is essentially a promise, a line of code, and that the actual physical cash you worked for is not just sitting there? The reality is the money you deposited isn't resting in a bank's vault. It was gone almost the moment you handed it over. Welcome to AR Investor. I'm AR. Today, we are going to look behind the marble pillars and the professional suits of the global financial system. We are not here to talk about get-rich-quick schemes or secrets found in a tabloid. We are here to understand a hidden architecture, the fundamental pillars of the banking system that dictate how wealth moves, why some people stay stuck in a cycle of debt, and why the rules of the game are often very different depending on how much you already have. By the end of this video, you will look at your savings account, your credit card, and even your mortgage with a completely different perspective. This isn't just about banks. It's about the very nature of money in the 21st century. Pay close attention because understanding these concepts is the first step toward true financial clarity. Let's begin. Let's start with the most basic concept, savings. Most of us were taught from childhood that saving money is the ultimate virtue, and while having an emergency fund is vital, there is a silent force working against you every single day. This is the battle between nominal value and real value. If you put $100,000 in a savings account today, and the bank gives you a 0.5% interest rate, a year from now you have $100,500. On paper, you have more money. This is the nominal value. However, we must look at inflation. If the cost of goods like bread, fuel, and housing rises by 5% in that same year, your new balance can actually buy less than your original deposit could a year ago. This explains why a bank account is often not a wealth-building tool. It is a storage tool that, in many economic climates, leads to a slow loss of purchasing power. The system encourages you to store your money where it loses value, while the bank uses that same money to seek much higher returns elsewhere. This brings us to a concept that sounds like a myth, but is actually standard global law known as fractional reserve banking. When you deposit $1,000, you assume the bank keeps that $1,000 in the vault. In reality, banks are only required to keep a small fraction, often as low as 10%, as a reserve. If they keep $100 and lend out $900 to someone else for a car loan, the system now records that you have $1,000 and the borrower has $900. Suddenly, there is $1,900 in existence where there was once only $1,000. Where did that extra $900 come from? It was created by the bank through the act of lending. Most of the money in the world today is not printed on paper. It is digital credit manufactured by commercial banks. This helps you understand that the system relies entirely on the fact that not everyone will want their cash at the same time. Now let's talk about the bank's most effective product, credit cards. Why do banks offer rewards, cash back, and interest-free periods? It's because the true profitability of a credit card doesn't come from the people who pay their bills on time. It comes from those who carry a balance, the revolvers. When a credit card carries an interest rate of 18 to 25%, it becomes a mathematical trap. If you only make the minimum payment, you aren't really paying off the item you bought. You are primarily paying for the privilege of the delay. Banks understand human psychology. They know that digital spending feels less painful than handing over physical cash. The system is designed to allow you to spend your future labor today, ensuring that a portion of your income for the next several years belongs to the bank, not to you. Have you ever noticed that the more money you have, the cheaper it is to live? This is one of the most sobering realities of finance. A person with a low credit score or small savings might be charged 12% interest on a loan. However, a billionaire or a massive corporation can often borrow at rates mere 1 or 2%. Why? Institutions view them as low risk. But look at the math. The billionaire is borrowing money at a rate lower than inflation. In essence, they are being paid to borrow money, while the average worker is paying a massive premium just to access capital. This explains why the gap between the ultra-wealthy and the middle class continues to widen. The cost of money is not the same for everyone. In the world of the wealthy, debt isn't something to be feared. It's a tool called leverage. An average person often uses debt to buy depreciating assets like cars, clothes, or electronics. These things lose value every day. This is what we call bad debt. Conversely, an investor uses debt to buy appreciating assets like real estate or businesses. If an investor borrows money at 3% to buy an asset that grows at 7%, they are using the bank's money to create a 4% profit for themselves. The bank facilitates this for the wealthy because the collateral is high value. One way to think about this is that some people use debt to build a ladder, while others use it to dig a hole. This leads us to a strategy many billionaires use to minimize taxes with the full cooperation of major banks. It's often referred to as buy, borrow, die. If a CEO owns $10 billion in company stock, they don't want to sell those shares to buy a lifestyle, because they would have to pay billions in capital gains taxes. Instead, they go to a bank and take out a massive loan using their stocks as collateral. Because a loan is not considered income, it is not taxed. They get the cash, they buy the yachts and mansions, and the interest on the loan is often much lower than the growth of their shares. They stay wealthy, the bank gets a safe interest payment, and the government receives no tax. This is a legal framework that is simply not available to someone earning a standard salary. Beyond your local branch lies a global network of tax havens and offshore accounts. It is estimated that over $8 trillion are stored in jurisdictions with 0% tax rates. This isn't just for movie villains. Many of the world's largest corporations use these legal structures to move profits away from high-tax countries. By using complex mailbox companies, wealth is shielded from the public infrastructure it was built upon. While the average citizen has their taxes deducted before their paycheck even hits their account, the global elite use the banking system to navigate a borderless world of tax efficiency. Let's talk about the dream of homeownership. When you sign a 30-year mortgage, you might feel like a homeowner. But for the first 15 years, the majority of your monthly payment doesn't go toward the principal, the actual house. It goes toward the interest. If you buy a house for $300,000, by the end of 30 years, you might have paid the bank over $600,000 in total. The bank isn't just a lender, they are effectively a silent partner who takes a massive cut of your labor for 3 decades. If housing prices drop, you keep the risk. If prices rise, the bank has already taken their guaranteed profit first. While the wealthy receive concierge service, the average customer faces a barrage of small fees. Overdraft fees, maintenance fees, ATM fees. These might seem like small amounts on your statement, but collectively they generate billions of dollars in pure profit for banks every year. Ironically, these fees most heavily impact those who have the least amount of money in their accounts. It is a system where it is literally expensive to be poor. We also have to understand that banks are businesses that take risks. As we saw in the 2008 financial crisis, banks often bundle debt and trade it as an investment. When those risks pay off, the executives and shareholders receive the bonuses. But when those risks fail and the system threatens to collapse, governments often step in with bailouts funded by taxpayers. This creates a situation where the upside is private, but the downside is socialized. It is important for us to realize that our safe deposits are part of this global risk pool. Beyond traditional banks, there is a shadow banking system including payday lenders, check cashing stores, and high-interest title loans. These services exist because many people are unbanked and they don't fit the strict criteria for a traditional account. These individuals often pay the highest premium of all, sometimes paying 300% or 400% annual interest. This helps us realize that the banking system is a hierarchy where the entrance fee is financial stability. Have you ever wondered why you learned about complex geometry but not how to read a loan contract or how taxes work? Financial literacy is arguably the greatest threat to a bank's profit margin. If every customer understood the math of compounding interest on debt, or how to avoid unnecessary fees, or how to invest in low-cost index funds, the banking industry would look very different. Knowledge is power. The less you know, the more profitable you are to the system. The final pillar is trust. The only reason the system works is because we all agree it works. This is called liquidity. We believe that if we go to an ATM, cash will come out. But as we've seen in bank runs throughout history, if everyone loses trust at the same time, the illusion vanishes. The bank does not have everyone's cash on hand. It is a system built on a delicate balance of public confidence. So, does all this mean you should fear the bank? No. The banking system is a tool, one that provides the grease for the wheels of our modern economy. However, you cannot use a tool effectively if you do not understand how it was designed. The secrets we discussed today aren't hidden because they are illegal. They are hidden in plain sight, buried in the fine print of our daily lives. Now is the time to stop being a consumer of debt and start being an architect of your own finances. Understand that a savings account is for emergencies, not for building wealth. Realize that credit cards are a high-stakes game that require discipline. And most importantly, learn to distinguish between debt that drains your future and debt that builds it. At the R Investor, my goal is to provide the educational foundation you need to navigate these complex waters. Financial freedom doesn't come from a secret strategy. It comes from understanding the rules of the system better than the system understands you. If this deep dive was helpful, please let me know in the comments which of these pillars surprised you the most. I'm AR. Thank you for watching. Stay informed, stay focused on your goals, and I will see you in the next video. This video is for educational and informational purposes only and does not constitute financial, investment, or legal advice. Always conduct your own research and consult with a licensed professional before making significant financial decisions.